Real estate syndication is a powerful investment strategy. It allows individuals to pool their money together. This collective investment power grants them access to larger and more profitable real estate projects. These projects would be difficult to undertake individually. In essence, it's a team effort in the world of real estate. Instead of going solo, investors become part of a group. This group, under the guidance of experienced sponsors, pools resources. Together, they acquire, manage, and eventually profit from a property. This approach not only lowers the entry barrier for many, but also diversifies risk. Think of it like joining forces to buy a bigger, better property than you could afford alone. A shopping mall, for instance, or a large apartment complex. These ventures, typically out of reach for individual investors, become achievable through syndication. This collaborative approach opens doors to a wider range of opportunities. It allows investors to participate in projects with potentially higher returns. That's the beauty of real estate syndication, leveraging collective power for greater financial success. In the realm of real estate syndications, understanding the roles of sponsors and investors is crucial. Sponsors are like the orchestra conductors, identifying promising real estate deals and bringing together the financial backing to make them happen. They're responsible for the entire project lifecycle. Sponsors wear many hats, from sourcing properties and securing financing to managing the day-to-day operations. Their expertise lies in identifying undervalued properties with strong income potential or appreciation prospects. Essentially, they handle the heavy lifting, allowing investors to reap the benefits without the hands-on work. Investors, on the other hand, are the financial backers of the project. They provide the capital needed to acquire and manage the property. In return for their investment, they receive a share of the profits generated, typically through rental income and property appreciation. Investors seek passive income and long-term growth without the everyday hassles of property management. They rely on the expertise and experience of the sponsors to maximize returns. A successful syndication relies on a strong partnership between sponsors and investors. Real estate syndications offer a compelling avenue for both seasoned and novice investors. One of the most significant advantages is the potential for passive income. Investors receive regular cash flow from rental payments without lifting a finger in property management. Furthermore, syndications provide an avenue for building long-term wealth through property appreciation. As the value of the property increases over time, so does the investor's equity, leading to substantial gains upon sale. Another key benefit is the tax advantages associated with real estate investing. Investors can benefit from deductions on property taxes, mortgage interest, and depreciation, reducing their tax liability. Moreover, syndications provide a valuable tool for portfolio diversification. By investing in real estate alongside traditional assets like stocks and bonds, investors can spread their risk and potentially enhance their overall returns. Lastly, one cannot overlook the power of professional management. Syndications grant investors access to experienced professionals who handle all aspects of the investment, from acquisition and financing to property management and tenant relations. Section 4. The Syndication Investment Process. Investing in a real estate syndication starts with finding a reputable sponsor. Sponsors can be found through online platforms, conferences, or referrals. Review the sponsor's track record and current offerings. Conduct due diligence on the investment opportunity. This includes reviewing financials, market analysis, and legal documents. If satisfied, commit capital by signing a subscription agreement and transferring funds. Once funded, the sponsor acquires the property and starts management. Investors receive regular updates on financials and property performance. Section 5. Potential Risks and Mitigation Strategies. While real estate syndications offer attractive benefits, it's crucial to acknowledge the inherent risks. Like any investment, syndications are subject to market fluctuations, which can impact property values and rental income. Economic downturns can further exacerbate these risks by increasing vacancy rates and decreasing rental demand. Another risk to consider is the potential for mismanagement by the sponsor. While rare, sponsors with poor track records or inadequate experience can negatively impact the investment's performance. Moreover, unexpected expenses such as major repairs or unforeseen property issues can erode profitability. To mitigate these risks, investors should prioritize due diligence. Thoroughly vetting the sponsor's experience, track record, and financial stability is paramount. Equally important is conducting independent research on the property, its location, and the surrounding market conditions. Diversifying across multiple syndications can further mitigate risk by spreading investments across different property types, locations, and sponsors. Remember, a well-diversified real estate portfolio can cushion against losses and enhance long-term returns. Section 6. Legal and structural considerations. Importance of due diligence. Real estate syndications are governed by specific legal frameworks that vary by jurisdiction. Investors should review all legal documents, including the Private Placement Memorandum and Operating Agreement. The Private Placement Memorandum outlines investment terms, sponsors' fees, and risk factors. The Operating Agreement defines roles and responsibilities, ensuring clarity. Consult with professionals to understand these documents fully. Due diligence is crucial throughout the investment process. Verify the sponsor's credentials and assess the property's condition and market value. Real estate syndications can build wealth and generate passive income. Due diligence, research, and understanding risks are essential for success.